Welcome to the Colorado Homes and Living YouTube channel. I'm Kelly Mates,
And I'm Jill Jackson.
and we are here with Bryce Waite.
Citywide Home Loans.
Hi, guys.
We discuss all the ins and outs of Colorado and the real estate market. Whether you are looking to buy in 10 days, 10 weeks, or 10 months, it's never too soon to reach out.
And we are local realtors here in the Denver metro area. And we do these videos on a weekly basis in hopes that you contact us. If you find this content useful, please subscribe to our YouTube channel. There is a QR code in the upper right corner of our banner, and that will link you directly to our website. And of course, we will link our phone number below as well. On today's video, we are going to be interviewing Mr. Bryce Waite with Citywide Home Loans, and he is going to be discussing with us closing costs and how they differ from an FHA loan and a conventional loan. Thanks for joining us today, Bryce.
Thank you very much. Happy to be here.
So, Bryce, tell us a little bit about yourself. How long have you been a lender?
Yeah, I've been a lender for roughly about 9 years now. I was in real estate prior to that and flipping properties, and I love lending. I think there's a lot of opportunity, and I think there's a lot of lenders who don't set strategies for clients. And I think that's what separates me is I set a strategy for the future and for now. And a lot of lenders just worry about what works now. Well, what about your future refinancing, the plans, multiple properties? I think that's what separates me more than anyone else. But yeah.
And so, Bryce, so what kind of loans do you specialize in?
All of them. All of them that matter. Yeah, first-time home buyers. I'm very big in the first-time home buyer community market here in the Colorado state programs. There's Denver Metro Mortgage Assistance Program. There's CHAFA. There's a few other programs, but that's what I mainly specialize in. And then I'm a veteran, so I also work with a lot of veterans, and we have no lender fees on VA deals. So I'm very big in those two positions. Of course, we do jumbos, conventionals, FHAs, all of that, but we specialize in those.
So, Bryce, for today is where are interest rates for an FHA loan as well as a conventional loan, and how often do these rates fluctuate?
That was a great question. And rates are variable between day to day. So that's something we'll talk about. If you average the rates today, we're averaging around a 5.99 higher fives. Now, averaging does not mean that's what a conventional is, or a jumbo is, or an FHA is. That's an average between all loans. Remember, government loans always have lower rates. They're more in the higher fives, 5.625, 5.875. Of course, depending on credit, income, assets, things of nature. Conventional loans, on the other hand, have higher rates. Those will be in the low sixes, might be touching high fives, depending on perfect credit or a 720 credit score.
So, why are conventional rates typically higher than FHA rates?
Because they're not government backed. When you're government backed, they have some fees that go with them. So I can break that down and go into FHA and conventional if you'd like me to.
I would love that, Bryce. Thank you.
Awesome. All right, I'll cover that. So conventional loans, closing costs that come into that, you'll have a 3%, 5%, 10%, or 20% down, right? It goes in intervals of 5. So you'll have your down payment there. FHA allows a 3.5% down. Most people think FHA is lower down payment than conventional. It is not. There is a 3% down as long as you're a first-time home buyer. Okay, that's key there. Secondly, closing costs. FHA is about 1.75% more expensive of the loan amount to close. The reason for that is the government has an upfront mortgage insurance funding fee that goes into the loan right in the very beginning. So therefore, that's 1.75% of the loan amount. So on a $500,000 deal, $500,000 loan amount, that's roughly about $8,000 in fees that roll into the loan. This is what makes FHA not attractive. What makes it really attractive is the rate is almost 0.5% to 0.25% lower. Also, conventional you do with a higher credit score. FHA you do with a lower credit score.
And I'm assuming that with FHA versus conventional, FHA does allow for higher debt to income ratios versus conventional, or?
Correct. It does barely because of the front end and back end ratios on debt to income ratios, but you can qualify for normally, I'd say 5 to 15 grand more, sometimes $25,000 more. FHA, it just depends on your front end ratio as well.
So, with all of that being said, how frequent do the rates fluctuate?
So the rates are kind of like the stock market. They fluctuate every day. But big news, right? Like people dumping money into mortgage bonds or the Fed's lowering the rates or unemployment. All those things have a big advantage to change the rates dramatically. But day to day, you can change 5 to 15 to 20 basis points. That's a deeper conversation. But when you get big news once a month, once every 2 months, that's when you see your big gains and big losses.
Ah, great. Well, thanks for sharing with us.
So, next up, we want to know, how do points work and when does paying points make sense?
Great question. We'll cover that. So, coming into that, a lot of clients think that if you pay 1 point, you get 1% off the loan, right? That is incorrect. Okay. In the financial world, 1 point means 1% of the loan amount cost. So, to break that down in simple form, you're buying a $500,000 house. Somebody wants to pay 1 point. That is 1% of that loan amount, not of your interest rate. So that'd be $5,000 cost for 1 point. Now, the big question is, if I paid 5 grand, how much lower does that get my rate? That just depends on the day, the cycles where the rate locks are. But it can gain you on average between, I'd say, a quarter a rate on 1 point, give or take. Either way, depending on what the market. Do not think you get a full 1% off. That's where the big confusion is. More details on this. We'll explain when a good time to do it, but more details, please reach out.
Yes, thank you. That's great information. So, when it comes to closing costs, how do they differ in each program?
So closing costs will stay pretty level across the game, because closing costs you can look at many ways, but the overall is what costs the client money above the down payment. That's what I try to view it as. Anything above the down payment is closing costs to a client that they bring to closing. So for example, I'll break the closing costs down. Would you like me to break that down?
Yes, please.
Awesome. All right. So first is your insurance. Okay. If you're escrowing, which escrows mean you're paying your taxes and insurance in your monthly mortgage payment, you will have 12 months of insurance prepaid upfront. This is your homeowner's insurance for a fire, a flood, wind, hail, things of those nature. If you're going to do insurance, you do 12 months plus 2 months. So if it's $300 a month, you'd be looking at roughly $3,900 for just insurance. After that, you have your appraisal fee. Appraisals are running between $600 and $750. That's a third party fee. That would be part of your closing costs. You have your credit pulls, your tech fees. Those normally run about $250 to $300 per person. And that gets all your information, your VOEs, things that needed to close the loan. Then you have your taxes. Depending on county, the structure, you'll do 2 or 3 months of your tax bill up front. Then you have what's called the lender fees, which is my side. Lender fees are roughly between $1,500 and $2,000 per closing that you will pay for process, underwriting, closing. That's what your lender cost will be. Then you have what's your title. In the state of Colorado, we use title to protect the clients. You'll understand that through this process. And please reach out for more details on all of this. But title will protect you if there's any kind of mechanics liens, meaning a contractor put a lien on your house, you bought it, but it wasn't the work you had completed. That will protect you. That's a roughly about another $1,500 to $2,000. You add all of this up, it comes to be about $8,000 to $12,000 in closing costs on average, on top of your down payment, which a lot of clients get confused about.
And so, would you say it's typically like 1% to 2% of your loan amount?
I would plan on 3% just to be safe. But yes, I would say, 2.5%, I think is very fair. But if you said 3, you're over buffering. And I think it's always nice to buffer as a client when you're talking your numbers. Say you're buying a $400,000 house. Okay. If you add the homeowner's insurance, the taxes, the title, the lender, the appraisal, the miscellaneous fees that are $200 for recording and little things like that throughout the process. You add all of that up, you're looking probably right around $10,000 to $11,000 out of pocket for that deal. So you're roughly about 2.5%, 3%, sometimes a little less around 2%, depending on the purchase price amount. And also depends on your insurance, taxes. Those make a huge play. That can change it over $1,500.
So, we know that your interest rate is affected by your credit score. Are your closing costs ever affected by your credit score?
Never. Credit score has nothing to do with affecting your closing costs.
And then just to piggyback off of what you just said there, Bryce. Now, oftentimes the sellers give a tax credit to the buyer. Does that tax credit usually offset that $10,000 to $11,000 in closing costs? And if so, about how much would you say?
Great question. So for example, if you close a house in January, February in the year in Colorado, your closing costs will be much higher, which we just quoted that roughly $10,000, $12,000 for a $400K house. If the taxes on that property are $3,000 a year and we close that house in December, you will get a credit for roughly about $2,800 if you close in December. So therefore that $12,000, $11,000 just dropped down to about $8,500 in closing costs to close a deal at the end of the year compared to the beginning of the year.
Great. Good to know.
So, we're in the first quarter of 2026. And so, why do you think buyers should use this time to purchase?
I think that any time between the winter months is the best time to purchase. As everyone knows, every single year we talk about prices are going down at the winter months. There's less inventory, which makes it harder to buy, but there's also less buyers, which means less competition. Homes been sitting on the market longer. We have the holidays. I think is the great opportunity to buy anytime, of course, when you're ready. But the winter time coming in January, I think is a great time to buy because you can still get a buy on the house before the summer months hit. starting March or April, which is the hottest months in Colorado.
Well, there you have it. Thanks again, Bryce, for taking the time to meet with us today and go over this useful information. Again, I am Jill Jackson,
And I'm Kelly Me.
and we are local realtors here in the Denver metro area. And we do these videos on a weekly basis in hopes that you contact us. If you find this information useful, please subscribe to our YouTube channel. And until next time, take care.